Gold regained some ground this week, following losses in the days before Easter. Friday's PM London fixed price was $1,666.50 an ounce, a gain of 2.2% on Thursday last week, the last gold fix before Easter. Traders in Asia this week saw a pickup in physical gold demand, following the end of a 3-week strike by Indian gold jewelers. However, price action was initially subdued as markets continued to digest last Friday's disappointing US non-farm jobs data. Gold then rallied on Tuesday, while stock markets fell. This prompted renewed talk of gold as a safe haven following months of it being correlated with stocks and other risk assets. This safe haven talk continued into Thursday morning as gold fell along with the dollar. The dollar, of course, has tended to rise on safe haven demand during recent episodes of market turmoil. Thursday then saw gold move sharply higher, holding on to most of its gains on Friday. Despite this week's rally, gold remains below its 200-day moving average, a measure followed by many technical analysts and which has closely tracked gold's uptrend since 2008. Bear in mind that as we move towards the anniversary of last year's record high, these 200-day averages are liable to rise even on a flat gold price. Indeed, were gold prices to move sideways, the 200-day average would peak at $1,700 1 month from now. Silver's action this week was very much a carbon copy of gold's, minus the so-called safe haven move on Tuesday. Friday's silver fix was $32.36, a gain of 3.5% on the last fix before Easter. That said, spot market silver prices were trading lower by Friday afternoon in London. The world's largest precious metals consultancy, Thomson Reuters GFMS, launched its annual gold survey this week. GFMS forecasts continued growth in gold mine production, as well as a record year for investment in gold. GFMS also expects a new record high gold price of around $2,000 an ounce, though it adds that the first half of 2013 might be a more likely time to see it. Economic growth in China, the world's second largest gold buyer, slowed in the first 3 weeks of the year, according to GDP figures out this week. Annual growth was 8.1%, lower than most forecasts and down from 8.9% the previous quarter. The Eurozone crisis looks like it might be rearing its head again. Spanish 10-year government bond yields breached 6% this week for the first time since December. Italy, meanwhile, saw its borrowing costs rise significantly at debt auctions held on Wednesday and Thursday. To keep up to date with the latest developments in gold and silver, visit goldnews.bullionvault.com.